Real estate investment, the best tips to make money with REIT. Have you ever been curious about investing in real estate? Or interested in diversifying your portfolio? This is a common curiosity amongst investors. However, traditional real estate is difficult to invest in and difficult to cash out of once you're invested. But you don't have to put up colossal amounts of cash to get into the real estate game. You don't have to worry about buying, managing, or financing a house or office space. You can invest in real estate just as easily as you can in any other company or asset class. How is this possible? Through REITs. Real estate investment trusts, or REITs, are companies that own, invest in, or finance properties, including residential, office, and commercial real estate. For a company to qualify as a REIT, it must meet several qualifications. For example, at least 75% of a REIT's total assets must be real estate. Further, at least 75% of a REIT's revenue must be derived from rent, interest on financing, or property sales. How do REITs make you money? As we've discussed, a REIT's primary investment is property. How do REITs make money so that, in turn, they make you money? Equity REITs derive most of their revenue from rent on their properties. Here's an example using simple, round numbers. Let's say a REIT owns 15 apartment complexes. Each complex has 100 tenants who each pay $1,000 a month in rent to live there. That equates to $1,500,000 a month in gross revenue, or $18 million a year. In reality, these apartment buildings would have monthly expenses for upkeep and property management. So, after deducting these costs and other corporate expenses, the remainder would be distributed to the REIT's shareholders, which would be you. In sum, REITs make money through rent collection, interest on their investments in real estate, or sales of properties. After factoring in expenses, this money then flows to its investors via annual, quarterly, or even monthly dividends. You can also profit off of REITs by selling your shares. Like any other stock, a REIT's price will fluctuate over time. If you reached your investment goals and are ready to cash out, you can sell your shares and recognize returns. What to look for in a REIT? For retail investors, REITs hold several advantages over investing in real estate itself. First of all, your investment is liquid. You can buy and sell shares of REITs, which trade like stocks on an exchange. Shares of REITs have low investment minimums. As well, investing directly in an actual property often requires a much more sizable commitment. REITs generate income from the rents and leases of the properties they own. The majority, 90%, of a REIT's taxable income must be returned to shareholders in the form of dividends. As a result, investors often rely on REITs as providers of a steady cash flow, though the shares can also appreciate in value if the real estate holdings do. When you're ready to invest in a REIT, look for growth in earnings, which stems from higher revenues, lower costs, and new business opportunities. It's also imperative that you research the management team that oversees the REIT's properties. A good management team will have the ability to upgrade the facilities and enhance the services of an underutilized building, increasing demand. Understand exactly what you're investing in. What types of properties does a REIT invest in? Where? Does the REIT invest directly or by lending, or both? How and when can you sell your shares, and under what restrictions? Most REITs specialize in a certain sector, which should be easy to find in the fund summary. Understand the risks of each sector. For example, REITs holding undeveloped land or retail shopping centers in a bad economy likely carry more risk than mid-range apartments in a growing metropolis. Review the numbers. Yes, you almost certainly check the income yield before anything else. But are dividends being paid from operations, or is the fund being forced to use additional capital? A well-run REIT should rely on its operations to pay for expenses and dividends. Also, stay wary of large, one-time real estate sales that might skew the financials upwards. Research the REIT's history. New REITs may have only operated in a growing market, and their strong yields could reflect luck or market strength rather than investing prowess. The true test of any investor lies in their performance during downturns and bear markets. Besides, if the REIT bought up properties before a market downturn, they could find those properties underwater once the market drops. In such cases, REITs may need to lower dividends or sell additional shares in order to raise cash in the near future. However, if the fund was created after a housing market recession, it could own and be buying valuable properties at bargain prices. Finally, research the people actually choosing the investments. Read everything you can about their experience, both in years and in actual performance. Look for strong teams with a proven track record of success. Know your time horizon. Real estate is inherently a long-term investment. If you might need to pull your money out within the next year or two, look elsewhere for shorter-term investments. Private REITs may not even allow you to sell shares within the first 5 years. If they do offer to buy back shares within the first few years, they usually do so at a discounted price from what you paid. Even publicly traded REITs often make poor short-term investments, as they're subject to similar volatility as stocks. Buy and hold shares of REITs, enjoy the dividends, and check on them periodically to make sure you're still happy with the returns. Regardless of the short-term swings, real estate remains a proven long-term investment opportunity. And REITs offer a simple way to diversify into real estate without the usual headaches and challenges, building passive income despite the low interest rate environment. As with all investments, make sure you do your homework and understand exactly where you are putting your money and why.